Okay, welcome to the penultimate session on this Tuesday, and this is a very exciting one with an all-star cast. I'm Puck Fernston, and I am your MC for today. If you didn't know, you're going to be learning about crossover funding, and after this, we're going to have the Secretary of Economic Development in Massachusetts and some gentleman from the Boston Globe named Scott Kirshner. So two good contacts after this. So stick around, enjoy this, and if you have any questions, make sure you raise your hands. Thank you very much, and Danielle, take it away.
So wanted to thank Startup Boston for having me speak again this year. Really appreciate it and happy to be here. So as mentioned, we're going to be talking about, crossover funding and IPOs. We're going to talk about the differences between equity funding, crossover funding, and an IPO, as well as, what considerations folks have going public in terms of legal and marketing and PR, and also kind of the milestones that folks should hit in order to then think about doing an IPO. I'm Danielle O'Neill. I am SVP on the life sciences team at Bank of California, focusing on pre-seed, seed stage companies. I'm also with Correlation Ventures as a network advisor, sourcing deals on the East Coast for them. And then I am an advisor for a company called CircNova, which is doing AI-driven drug discovery in the circular RNA space. So I'm going to have Steve, Julie, and James introduce themselves. We will start with James, since he's next.
We're not sitting in the right order. It's okay. So my name is James Schneider. I'm a partner in the Boston office of Cooley. Danielle has more jobs than me. I only have one. But I work with primarily startups and the investors who fund them in the healthcare, life sciences space primarily. But Cooley, as you may or may not know, has a global practice on the West Coast, East Coast, Europe, Asia. We're all over the place. We love working with startup companies and helping them, figure out what it is they need to do to go, start from incorporation, grow all the way, hopefully, to an IPO or an exit. My primary kind of specialty is in kind of the late stage public crossover space. Before joining Cooley, I spent the past 6 years as in-house counsel at a fund here in Boston called RA Capital in the life sciences space, one of the premier and kind of first to kind of start the crossover funding in the life sciences space. We did, if you are aware of an IPO in the life sciences space, we were probably in the crossover round before it, and I was probably negotiating those documents. So look forward to talking about it today.
Thank you, Danielle, and I want to thank Rob for inviting me to join you today. It's such a pleasure to be here. I'm Steve Dickman. I'm CEO of CBT Advisors. We're a consulting firm in Cambridge, and I've been working in the life science space about 25 years, spent some time as a venture capitalist, and then went back to my first love, if you will, which is storytelling. My secret, if you will, my fun fact is that before I was a venture capitalist, I was a journalist. I was a science journalist writing for The Economist and Science and Nature. And in my current role as a consultant, I also do a lot of storytelling. So whereas Cooley, which is the go-to for legal services for the entire startup universe, I couldn't be happier to have James with us today, is working across the board with companies at all stages. I am doing a very specialized role. Most of my work in storytelling is with companies on the cusp of IPO, preparing the all-important business section, their description of their business at the time of IPO. It's a kind of a coming out party. And my firm has been doing the business section work for about 10 years. We've helped about 200 companies on their path to IPO or other exit. We've had almost 100 client IPOs, and there's one actually, a Boston-based company, Bicara Therapeutics. That's a client of ours. We drafted their business section, and they are supposed to IPO, if all goes well, later this week.
Supposed to tell people that yet?
Nice.
I don't know.
That's public knowledge.
Okay. I'm Julie Feder, and thanks to Steve and Rob for inviting me. Steve helped write my S1, so I'm incredibly grateful to Steve. I'm the CFO at Aura Biosciences. I've been there for 6 years. I took that company from, I was the 18th employee, did a few private rounds, took the company public, and has since gotten their first drug and indication into phase 3. So super exciting industry. I spent many years in global health in the developing world, where I helped build an organization, tripled the global footprint, both on the programmatic side as well as on the funding side. I will just say that I've worked with Cooley on all of my deals. I've been on a panel with Danielle, and I'm forever grateful to Steve. So it's a pleasure to be here. Thank you.
Thanks, guys. So as you guys noticed, we're all kind of life sciences folks. So we wanted to know how many people in the audience are life sciences versus tech. So raise your hand if you're life sciences. Tech? Okay. Good to know. Thank you, guys.
We'll modify as much as we can. It'll be fine. It'll be fine.
Just harder because you guys make money. Our life sciences stuff is-
Yeah, revenue, what is that? So I just want to say too, throughout this session, we want it to be interactive. So if you have questions, just feel free to raise your hand throughout the session. And then, but we will have dedicated Q&A at the end. So I wanted to start by kind of setting the stage. So Julie, would you be able to explain the difference between equity funding, a crossover round, and an IPO?
Sure. So there's lots of different ways to finance a company. Like you said, if you're not making any money, there's different challenges. But we refer to the different rounds of financing as angel financing, Series A, B, C, crossover, IPO. It varies per company, but that's the general rule. Angel investors are usually your friends and family, internal folks, someone that you have a good relationship with, not a fund, not anyone from RA Capital. Series A is usually your first institutional round, and it's typically a VC fund. That you're from the life science perspective, you could likely be preclinical. You don't even have an IND yet. From a tech side, you may not even have your first IP. You're just still in the development stage. Series B and C is when you're building the company. Maybe you've moved into the clinic. You would have the opportunity with potentially some hedge funds and some other strategic investors or specialists or generalists. It's usually a mix, and you're usually funding to your next milestone. Crossover rounds is the IPO is so much more than just a round, but the crossover round really is like your coming out party. It's sort of, you want to bring in those handful of new investors that are known to fund public companies. They're usually longer hold type of investors. You hope, if in the life sciences space, you want them to hold your stock for a couple of years. They're usually pretty passionate about what you're doing. They're really more involved. They typically take a board seat, not all, but many. And it's really just your coming out party. Who you bring to the table there, people are sort of like, oh, they're going to go public. That we're excited about that. I would say the IPO, it's so much more than a round of financing. This is really how you're going to do business going forward. But if you want to talk about just what does it mean from a round, that's when you issue public stock that's traded on NASDAQ or New York Stock Exchange. Again, you would have a mix of investors. This is sort of where the big mutual funds typically come out. Well, they come out in crossovers, but it's really very positive if you have some mutual funds in your IPO. And this is now when you're trading on the public market, and these investors need to be your best friends. You need to engage with them. You want them to hold your stock as long as you can. And I guess we could talk a little bit later about what does it mean to be an IPO internally, because raising the capital in an IPO is just, unfortunately, just a small slice of what goes on.
Yeah, and we should also mention, like, not every company kind of follows the same path. So some companies could raise a B round, then go public.
Absolutely.
Some could, do it after their Series D round.
Some do it after Series E.
Yeah.
And one point, because it may come up later when we talk about some considerations when you're thinking about going public, is these rounds before you're in IPO. For folks who have not done this before, you traditionally issue what is called preferred stock to your investors, which is different. When you're public, usually everybody's buying common stock. They all have the same stock. It's traded. It has a clear price. When you're buying preferred stock as an investor, you're usually getting rights and preferences that rank you above the common stock. Common stock is generally what employees and founders get. Preferred stock is generally what investors get. And when you do an IPO, you need to convert all of that preferred stock into common stock. And oftentimes that is a point of negotiation in the crossover round as to how that will work. And it can sometimes be a sticking point when it comes time to actually do the IPO. So it is important to kind of understand how those mechanics work. We can talk about that more a little bit later.
Can I take a crack at this one too?
Oh, yeah, of course.
I loved your explanation because it was very linear. And at the same time, especially if there are people in the audience who haven't really been in touch with the life sciences and with these sorts of milestones. Milestones is the key word. When you're doing angel funding, you can often convince people to invest just because they like you, or because it's a great idea, or there's a market and everybody agrees there's a market. When you're doing Series A, B, and C, the investors are experts, and they're looking for, in addition to preferences, better terms on their investment. They're looking for almost guarantees that the technology is going to somehow work, that even if the main goal is not achieved, there's a fallback goal. They're looking really hard at milestones, and it's a very intense phase that sometimes lasts 5 to 10 years.
I'm not laughing at you because I'm just going to say this, and that's because every round before your IPO is likely going to be tranched. And if you don't achieve the milestone, when you say you're going to achieve the milestone, that next tranche is not going to look what you think it's going to look like.
Tranched, meaning like in
Which means
portions.
that you get, if you have a $30 million round, then you're only going to get 10. And
Or
then you're going to
6.
achieve a milestone and you're going to get 7 more. And then
Right.
But when you do an IPO, all the money comes in
Right.
at
So
one
I was just
time.
going to say, those investors who are doing the Series A, Series B, they're experts. They're looking at very specific achievements that the company is promising to accomplish in very tight time frames. That's true for tech as well as for life sciences. And it's really only in that last phase, that sort of run up to the crossover IPO round, where the mix tends to shift. The other group of investors you were mentioning, mutual funds, and you were mentioning like the crossovers come in, retail. So that is the big difference between IPO financing and all investment rounds that preceded it, is that the investment rounds, it's friends, family, and fools. In the angel round, anybody who likes you, who likes the product, thinks there's a market. And then after that, it's experts. And then at the IPO stage, you're going back to non-experts. And again, that's kind of where I come in. I have to describe that what Aura Bioscience is doing so that a non-expert can understand a light-activated therapy that works at the place where you put it, but it can travel a little bit, but only a little bit. I mean, there are all these nuances and details, and it's the explaining that I like to do. But it's also this sort of taking a story that was meant for experts and turning it into something that's consumable by a much broader audience.
Have to say, I read the S1, beautiful masterpiece for Aura.
Okay, thank you.
And I do agree with you on the early stage side. It really is about investing in the management team versus the assets
Absolutely.
sometimes. And I just will say as well, nice to be on top of the capital stack with that. We do venture debt. But anyways, so what key inflection points or milestones should a company hit, in your opinion, before they start to consider an IPO? We'll start with James.
Yeah, I think one thing to consider, especially, I know we have some tech folks in the audience, is do you need access to the public capital markets, right? You need to think about your business and whether or not it makes sense for you to be public, because as we'll talk about, there's a lot of additional burdens that come on you as a public company. And for the life sciences companies, right, it's often just a fact of life. It's so expensive to create these drugs, go through all the trials. At a certain point, you just kind of tap out of the private markets and need the extra liquidity that comes from being public. That might not be the case for a tech company. And what's oftentimes driving it instead is, it's almost like an employee retention idea. It's like at a certain point, you've had these people who have been getting these stock options that are, theoretically worth a lot of money, but maybe there's some sort of secondary market that they can, get some liquidity on. But for the most part, they are going to want liquidity for their stock options, and you're almost going public, to benefit them. And that's why, if you've heard anything about direct listings, right? There's this concept. I think Spotify was a direct listing, where you don't even raise money, right? Which is crazy to us as people who advise life sciences companies to go public and not raise any money while you're doing it. Like, wow, God, that's a lot of work to do that. But you're really just, giving yourself access to the public markets, both for, future capital raises, and for, benefit of your, workforce that has all these, that has taken kind of a lot of stock in lieu of cash. And so you're kind of making it up for them. So yeah, you want to make sure that like you actually need the cash and the kind of headaches that come with the cash that happens when you're public. And then, I'm giving that answer, which is not like a true answer, because I'm sure you guys are going to talk about some of the more interesting stuff.
That was a good start.
Yeah.
I have a question. I don't know if you'd know this, but you talked about folks selling employee shares on an exchange. Carta got rid of that platform, correct?
Yes.
Yes. Okay.
Yeah. Carta. Yeah. Carta at one point was. So I think they got in some trouble because they were doing some proactive reach out to sell shares that made some founders not thrilled, right? Because you want to control the narrative of, if insiders are selling, you want to, be aware of that. And so, they don't do that anymore. There are, as tech companies get larger, if they stay private, they're evolve these secondary markets, and it gets a little complicated. But there are ways to kind of get that liquidity without going public, but it's more straightforward to do that if you're public.
Thank you. Steve?
So what was the question again?
What key inflection points or milestones should a company hit, in your opinion, before they start to consider an IPO?
Sure, I'll keep it brief. You don't want to be a public company unless you have good news to give to the market. It is incompatible with being public to sit silently for 2 years, or even for 6 months, or even for 3 months. I mean, this is the other thing about IPOs. The IPO introduces a regime of quarterly announcements, at least quarterly announcements to investors about what's going on at the company. There's a requirement for disclosure. The regulations ramp way up at the time of IPO, right? So those regulations go kind of nuts at IPO
I'm
time.
just pause for a second. It's amazing to be a public company, okay? I don't want you guys to have this negative impression. There's work to be done. There's lots of exciting things. Let me tell you, you have way more access to capital as a public company than you do as a private company. Please don't be afraid, okay? It's going to be amazing. That's first of all. Second of all, when you think, and I'm trying to make this a little bit more general than life sciences, when you think about going public, first of all, you should never go public because you have to. Right? If you're at Series D, Series E, and you don't have access to anybody else that's going to give you money, and therefore you're going public, it's harder. Full stop. When you think about what are the milestones and inflection points to go public, it's really, really, if you go back to 2000, and I'm looking at you, 18, 19, 20, everyone and their brother went public, regardless of what level of development they were, right? Some people didn't have proof of concept, whether it was a technology or a biotechnology, right? I think today the markets are really a little bit harder. Some of it's not in your control. I agree with what you both said in terms of milestones and markers, but if you have a proof of concept and you know that your technology works and you have a plan over the next, whether it's 3 months or 3 years, to show value over that period of time, and you want access to capital, that's the opportunity. I think it's really challenging to go and you're in the discovery phase, whether you're doing a drug or you're doing a technology. But if you have proof of concept and you have a reasonable path to get out there, that's a great opportunity to take the company public. Now, I think, and I have said this on podiums, I have said this in front of investors, and I'll say it in front of you guys, this concept of needing to have information and needing to have positive new news flow every quarter is killing industry today, okay? We're going to try to change that. It's companies, we're working with investors to help them to try to understand that. If you go out with a subset of data and you're at 100%, it works 100%, and then you're ready to read out your full study or your full testing of a certain technology, you have no place to go but the same or down. We're not creating value that way. So yes, you have to report every quarter, but we need to get people to understand this stuff takes time, and we're going to wait to give you information. So we really need to find a better balance.
I'm so glad you said that, because
great.
it's true that there's a movement to try
Yes.
to change the regulations, but I
No,
gotta.
no, no. We should report every quarter. We just don't have to report new information. We support our financials. You're a public company. It's not your money. It's not your company. It's the public's company. This is now not yours anymore. And if you're a founder, if you take this company public, wrap your head around it. It's the hardest thing for founders to wrap their head around, that this company is no longer yours, it's the public's. There are books written about it. I think, but you still need to be full disclosure on your financials every quarter. It holds you accountable. But the concept of showing new information and improvements on what you showed last quarter is really become a challenge.
I just want to say, again, I'm really glad you're bringing it up, but I'm pointing it out. It's a bit of a battleground because it's not like this is going to happen overnight. And the reporting requirements, and they are financial reporting requirements, right? They're not tell us a story requirements, but the culture of quarterly investor releases by companies, the culture is very much one of, tell me a better story this quarter than last quarter, or I'm going to make your stock go down. And so I was pointing out that that's the world we live in, and you're pointing out that we could be living in a better world in 2, 4, 7 years. Who knows? Sooner the better, I guess.
I have a question, and then we'll get to that question. I don't know if anyone will want to answer this question, but what do you do if your investors are like, hey, we're closing the fund, we really want to cash out and return our money to our limited partners? How do you approach that?
Are you a private or a public company?
Private.
So to some degree, let me just say I haven't experienced this. However, to some degree, there are different challenges whether you're a private company or a public company. If you have someone that owns a percentage of your shares and they need to take their cash back out, they can no longer hold it, and you're not planning an IPO, you're not planning a transaction where they can trade. There's something called a block trade. I mean, I'm assuming it's the same thing in both private and public, but you just need to find another investor who wants to take it. Now, the challenge with that is that if you have an investor and they have 20 million in your company, and then they say, we're shutting our investment down, and we have to give the money back to our LPs, we need to have our return right now. You just, can find another investor who's going to take that position, but then you don't get the money, whoever the investor, like if investor A is going down, investor B can buy it from investor A. So company Aura. It's
neutral.
It's neutral to the company. Yeah. And it also then limits that investor B's whatever, I don't know how much they can give over time, right? Are they capped out? So it's really finding that right investor that really is interested in coming in the company and that is willing to take the position. My recommendation is that find an investor who's willing to do more than that investment so that they can support the next round.
And it'd be a
almost never
secondary.
happens.
Oh, sorry.
It almost never happens,
Yeah.
what you asked about,
Yeah.
for these reasons, because it's a tough fit to find someone.
Yeah, I mean, so you'll sometimes
it happens
see.
more than you think. It happens. Oh, it
So
happens.
yeah, I mean,
Yeah.
if you're a company that has this happen to you, I think you want to be intimately involved. So the best way that I've seen this happen, in part because the company almost has to be involved, right? Because if you're going to buy shares of a public company, all the information that you need to know whether or not you're going to buy or sell a company is public, right? That's why you can log on to a Robinhood account right now and buy Aura Biosciences or whoever you want.
That would be great, eh? Mark? I'm just kidding.
But if to decide whether or not you want to buy shares of a private company from another investor, you need the company to kind of open up its books and records and let you do some due diligence, right? There's probably not enough information about a private company that a fund would feel confident making a significant investment. And so usually when I've seen this happen, the company is kind of involved and they know, right? Like it's usually a company that's maybe had a longer lifespan than was anticipated. The thought was that it would, go public and the markets weren't, available. There was bad news on a trial or something. And the investor kind of comes hat in hand and says, listen, I'm kind of tapped out and, LPs need, we're at end of life in the fund. We really need to find an alternative. Like, can you help me, right? And then the investor or the company may go to a investor from a prior round who maybe didn't get as much of that round as they wanted to, right? And say, here's an opportunity to buy some. And so it does happen, and it's usually it's usually something you can facilitate as long as you are still doing well as a company, right? Like if the investors tried to get out because things are going poorly, what I've sometimes seen is sometimes investors just want to get the investment off the books, right? And maybe take a tax write-off for the loss. And so sometimes you can just buy the shares back for like pennies, right? Like
I was going to say the amount of the discount is what determines whether the deal really gets done. And if the discount is big enough, the deal can get done. But a lot of times there's an impasse over what the discount should be.
Can I just give the key takeaway here? The most important thing you can do when you're getting ready and you're further along in your proof of concept, engage, 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 engage. You shouldn't have to go out and find that investor at the 11th hour. You should already know who they are. You need to be in constant updating people on your technology, where you are in the life cycle and what they can expect. And it actually goes a little bit smoother if people are already familiar with your story.
And also, it's important to figure out if you're getting invested in by a fund, where you're going to be in the fund's life cycle, because there
Yes.
is a designated period for funds. And I'm sorry, we had a question.
Hi, Katie Shorey with Startup Maine. We are a convener and a champion of the entrepreneurial ecosystem. And so my question is really around environments and culture. So in Maine, we have a very vibrant, active startup community, tech companies. We have 470, maybe even closer to 500 life science companies now because of our proximity to Boston. But yet we only have 10, but now going down to 9 publicly traded companies. And every time I talk to founder, you hear the topic more of, oh, we want to get acquired. There's an example, Capital One acquired a company in Maine not that long ago. So I guess my question is really around, does there need to be an environment or a culture for them to consider IPO? Because we just don't hear it as much about people considering going public. Like, it's more that they're interested in either acquisition by a PE or something else. But why are we, and maybe this, I know I'm bringing Maine into Massachusetts right now, but it's interesting that why is there not more of a talk about Maine companies wanting to go public?
So over what period of time are you looking at?
Oh, I mean, the past 10 years. The most recent one that happened is Covetrus. And the IPOs that we still talk about as successful are WEX, IDEX. Like, these are 25 plus years old now, and we're still talking about them as our shining stars, and they're old news now. Whereas Covetrus is somebody from IDEX started a company, it got acquired by another vet health company, and there's Covetrus now. But I mean, we have not seen any companies go public. But yet we have, I mean, if we're even staying in the lane of life sciences, we have hundreds and hundreds of life science companies, but this topic is not popular in Maine. And I'm just trying to understand if there's an environmental or a culture issue.
So I've not spent a lot of time in Maine, so I don't know. I don't know what's going on there. I think it's a beautiful place, it's a beautiful place. I actually think it's less to do with the environment or the culture in the location where the company is, and it's more to do with the environment, the culture, and the backers of the companies there. Because when you're an investor, they're looking for an exit. IPO is only one exit. Right? Transaction is another exit. Merger is another exit, right? So I think it might have to do more with the companies and I talk to a lot of companies and a lot of board people on different boards, and again, the same thing. You should never take a company public because you have to, and you should never put your company up for sale. Right? You should, if somebody wants to talk to me, I'm always happy to talk to you, but I'm not for sale, right? Everybody's for sale, right? Let's be honest. So I don't know if it's an environmental or a cultural thing. It might just be that group of people that have done this multiple times and that are sticking together, that's what they view as an exit.
I also want to say it's not just Maine. There has been a dearth of IPOs generally for the last 3 years. Since 2021, it's been a very low flow. And that's true globally, but it's even true in Boston and San Francisco. The numbers are way down because 21 was a glut of IPOs, and the market was oversaturated with companies that, as Julie said, had not achieved enough milestones or didn't even have proof of concept for their basic technology. The hangover, if you will, from that is still persisting today. So that's one factor.
Yeah, I think there's also just a general sense that there's in the life sciences space, it's big pharma. In tech, it may be big tech, but there's a general sense that a lot of companies are sitting on a lot of cash and are able to make acquisitions and are looking to be acquisitive. And so, yeah, I've definitely heard from both investors and from companies that right now, at least and things may change, hopefully soon, that a lot of times the kind of the view towards an exit right now for the past couple of years has been skewing towards acquisition seems more likely than an IPO just because of, general market dynamics.
And especially because now it's a main thing, the specific kinds of companies that grow up in ecosystems outside of Boston, San Francisco, maybe the New York metro area and Research Triangle Park, San Diego, all the other companies in the industry tend not to be the sort of high-flying gene editing therapeutics companies. They tend to be much more blocking and tackling, revenue-driven growth companies that by and large are built to eventually be acquired. Like they're not necessarily from the get-go the kind of companies that would capture the imagination of the IPO investor audience.
Yeah, and it's also, goes without saying, proximity to capital. Unfortunately, a lot of VCs would, prefer to run around Kendall Square and do all their board meetings versus driving up to Maine. So,
Well, they'd
Zoom
say,
could be your friend. Yeah. Could be your friend. Yeah.
Danielle, we got a couple of questions.
yep, sure.
Yeah, so my impression was you're saying investors like IPO better than merger and acquisition. So we have to know.
No, an exit is an exit. So if you're an investor, as long as you're getting your exit, you don't necessarily care. It depends on the value that's being generated from the transaction. If you're going to do your IPO, I'm making it up at $14 and your preferred shares are at $3, that's a fantastic exit. If your shares equate to the cost of the company, but you need to sell it, you have a 2 times or 5 times or 7 times the ROI requirement, then the acquisition needs to be higher, right? So I don't know that. I think it depends to the investor if they prefer an IPO or I don't think it's a general rule.
So is this an important factor when we are finding investor for fundraising? We study them to know that what type of exit they like?
So I do think it's helpful to understand their philosophy and what they're looking for. Expectation setting is critically important. My philosophy, and maybe it's just the investors I work with, I don't know, is you should never invest in a company and you should never grow a company just for an M&A. You should always be making critical strategic business decisions as if you were going to run this company forever. And if an M&A happens, fantastic. If you start building your company just based on the M&A lens, you're creating quite a bit of risk. So most investors that I work with sort of have that philosophy. Their favorite topic is a parallel track. Let's get a parallel track, IPO and transaction. Let's see which one hits first.
Yeah, and then the last question, I promise, that so for early stage startups, like when they look for angel investors, so what's the perspective of angels usually for like exit?
They just feel so bad for you, they want to give you money. They're not going to have an exit strategy. That's not the culture of the person. That's not why they're investing. It's once you get to Series A and B that you should, in my opinion, start talking about where you expect the company to be.
Yeah, a typical angel investment will have relatively lighter kind of controls and blocks on what you can and can't do. I think if you are getting an angel investment pitch where it seems like they're taking a lot of control of the company, I would be more wary of that.
Yes.
That's kind of what I would think.
If your mother's still telling you what to do, she's not a good investor.
And one thing I just wanted to say quickly on the IPO versus like M&A and what an investor might prefer. Certainly as you get later stage, and if you are considering an IPO, it is important to talk to your investors, and this is in a crossover round, understand which investors both can and are willing to continue to fund the company after an IPO. There are types of funds that are set up in a way that they really can't continue to participate in the public markets after you are public and are
Right.
mostly viewing the IPO as an exit for them, right? They will distribute the shares down to their individual LPs, and they're kind of washing their hands of the company at that point. There are other investors, particularly the traditional crossover investors, who this might be their first investment into you, but they are anticipating, putting more cash at play when you have, some event that you're going to fundraise off of in the capital markets, when you're trying to, raise $500 million off of, great phase 2 data that you just announced. They're going to be there and already know your story, right? They're going to be like a little bit easier pitch when it comes time to raise money later. And so kind of knowing which investors are going to do what is very useful as you're in the crossover stage.
I think we had another question.
Excellent. Can you please present yourself and ask the question?
Hi, I'm Ray Knox. Fascinating advice, and I love the stories. Prior in small startup world, seen a lot of the trying to get to IPO. One of my questions really is around your experience, if anyone on the panel's experience with SPACs. If so, pros and cons, and maybe a little description what a SPAC is versus an IPO in that sense. But really appreciate the comments so far.
You answer this one.
Yeah. So as I said before, I was in-house counsel at RA Capital. We had a SPAC, so I can speak about pretending to know what they are, because that's what I had to do. A SPAC, for those unfamiliar, is
You're still faking it?
We all are.
well, they're back now, actually.
Right. Better learn it.
A SPAC is basically a company. It's basically like a holding company almost that goes public, and you invest not really in the company, but in the people who are behind the SPAC. So if like an RA Capital SPAC, you would be investing really in RA Capital's ability to kind of find a company that is private now, but that could go public via a merger with the SPAC. And there were different flavors of SPACs as they happened, and I think the ones that got a bad name tended to have what was called warrant coverage for the people who created the SPAC. And you would basically get, extra economics for the SPAC founder once the deal happened that almost made it a kind of, win-win type situation for the SPAC sponsor, which is what it was called. And there were SPACs that went out without this warrant coverage. And I think in the life sciences space, we tended to see those a little bit more. But yeah, generally it was it was thought of as a kind of like an interesting way to kind of get a company public with a kind of crossover round type fundraise at the same time. And investors liked them because you could control the kind of syndicate funding the company as part of what was called the de-SPAC process, making the private company into the public company, whereas the IPO syndicate is controlled by the banks a little bit more. Maybe the investors want to have more of a hand in that. What ended up happening is that the SEC kind of took a closer look at the SPAC process, and depending on who you ask, either created new interpretations of existing rules or interpreted them better, and kind of just made it a lot harder to be a de-SPAC company. It was harder to get liquidity if you were an investor in a de-SPAC company. It was harder to fundraise after your de-SPAC. You had to wait a year, for example. And so they kind of fell out of favor for what are called reverse mergers, which are very similar. I won't go too much into it. But then the reverse mergers got harder for similar reasons. And now a couple of investors are back out with SPACs. So I think for certain companies, they make sense. But in general, if you have the IPO market open and available to you, I think it's probably your preferred path to liquidity.
So can I just add one thing to that? So it's not a traditional path to going public. It was traditionally viewed sort of as like the stepchild of going IPO, right? It did come back with a vengeance in 2020, 2021, and early 2022, but I think a lot of companies found that there was something called redemption rights also, and that the people that had invested in the SPAC entity, so the public company shell, that was just out there looking for a company who needed cash but had great science or had great technology. What happened is they said, well, we're going to give you the $100 million. That's how you're going to go. You're going to go public through our SPAC. We're going to give you the $100 million, but we're going to take 50 of it back because we have something called redemption rights. And so many companies found that in parallel to the SPAC process, they had to do this crossover IPO raise, and companies realized that they were just anyhow raising the same money, and they didn't have control of who they wound up losing the control of who the syndicate was going to be. So I think it was in fashion. I can guarantee you it's going to come back in fashion. I can guarantee you they're going to read the regulations differently to justify and satisfy what the market needs. I think it's a little bit out of favor right now. I think it's
I
gone
was
down
certainly not as
significantly.
in favor as it was in 2020.
And two more quick points to what the erudite answers of my fellow panelists. The one thing is the companies were typically those in that era where SPACs were very popular, the companies were typically a little less mature, if you will, than typical IPO candidates. Not necessarily much less and occasionally more mature, but typically a little less, like not quite worthy of an IPO in the eyes of banks or IPO investors, and therefore going this alternate route, that sort of stepchild thing that Julie said. And then the other thing is, and it's something that a lot of companies might not have thought about as they were getting excited about a SPAC, I'm not a bank, okay? I work with them, but I don't represent them, but I'm going to sound like a bank. You don't get the analyst coverage from the banks. And in our business, that's really important. It comes back to the storytelling aspect. As a company, you'd want to not be alone out there shouting in the wilderness about how great your technology is. You want JP Morgan, Jefferies, Evercore, Morgan Stanley, Leerink, all touting what a great technology you have through their analyst coverage. And SPAC recipients typically had to go out and work each individual bank, and they didn't have this sort of process that cohesively assembled a syndicate of banks that wanted to both take them public, make 6% on the transaction, and offer them years of analyst coverage. It was a trade-off I think some companies entered into not knowing what they were missing.
James, I was going to ask you to explain the difference between a SPAC and a reverse merger, but I won't put you through that.
I can. You'll all just be extremely bored.
So what are the major changes that you've seen in the management team as a company moves from private to public? We'll start with Steve.
From private to public, I mean, mostly in the life sciences, which is my clientele, mostly it's addition. It's not subtraction, and it's not exchange. It's addition. The management team grows, the C team in particular grows, and the executive or executives who are added at the stage of IPO, depending on how advanced the company is towards developing a therapeutic product, typically are people like the chief medical officer and the chief commercial officer and the chief financial officer, to be honest. Because I'll go in reverse order. A lot of companies don't really, quote unquote, need a CFO. Biotech companies that have no revenue and have no prospect of having revenue until years after their IPO, they will eventually need a CFO, but they don't, quote unquote, need a full-time CFO doing quarterly reporting, tax, audit, et cetera. They maybe could get by with a half or a quarter-time person, and that's much more economical to do that, and the pool of available CFOs is limited. So that's one hire that tends to happen sometimes very close to IPO, sometimes a year before IPO. Sometimes the person's employee number 18, and it's a while before the company will, go public and the CFO is already doing a full-time job. It varies. CMO and chief commercial officer, there are very specific tasks that those people need to carry out, and they're extremely in demand. I mean, it's even tougher to find a chief medical officer than a CFO. I always say it's the hardest hire for a growing biotech company. Chief medical officer is the one who's going to run the clinical trials and explain the rationale for the clinical trials to investors and to potential pharmaceutical and strategic partners, and ultimately to retail investors at investor conferences. And that chief medical officer role, I made it sound like an explainer, but it's a very active role in the guts of the company, making sure that the patients are recruited appropriately and that the trials are run properly. It's a job for an extremely skilled individual, and often an MD or an MD PhD. And it's just very hard to hire these people because they have lots and lots of career options. So that tends to be one of the later hires, sometimes after IPO or just before IPO.
Can I disagree? Is that okay? Okay. So I feel a little differently. I think it really depends on the stage of development that you're at. When I interviewed at Aura, and the board member that interviewed me, no longer a board member, I have a great relationship with them, terrific person, but said to me, "You've never taken a company public before. Why do you think you could be a CFO of a public company? Who are you?" I thought that was rude, but it was a good question, and the answer is, listen, and no offense to Cooley because I love the team from Cooley, but my answer to them was when you decide to take the company public, the lawyers are going to give you a 200-page document, and it's called a checklist, and it's going to tell you by day what you're supposed to do, when you're supposed to do, and how you're supposed to do it, and I can follow a checklist as good as the next person. It's not about that. The CFO's job isn't about it. Yes, it's their job to get it done, but it's very prescribed. They've done it so many times, they could tell you how to do it. The job of the CFO is to be that person who's going to bridge the science and bridge the money. It's out there telling the story, and it's out there partnering with the CEO. So when you think about the leadership team, it really depends on your stage of development. If you're already in clinical trials or you're already past your proof of concept testing on the technology side, maybe you're in beta testing, maybe you're rolling out version 2.0, you already have your chief medical or chief technology officer. That role is, if you're entering the clinic, you need to have that role. That I don't view CMO as an going public role. The two roles I think about when you go public is the CFO. I think it's most investors and banks are going to say you need a CFO. And yes, there are not an overflow of them. But I would also say the other position that becomes important, and I don't know if it's at the IPO or within a period of time of the IPO, is general counsel, is a chief legal person. Every decision you're going to make when you're a public company, you have to think about it in the lens of, do you have to tell the public that now? Is that material information? Did I say something wrong? Am I not supposed to tell anybody that yet? I have to file these 87 documents every time someone sneezes. So I think the two positions that I think that are critical when you go public, your CEO you already have, your chief of all operations you probably already have. It's more on the admin side, which is the CFO and the chief legal person, I think.
Yeah, we often tell companies that it's a pretty good idea to, I think, bring a general counsel or a counsel of some sort on prior to the IPO, even if it oftentimes is someone who works at Cooley, and then we have to hire somebody new. But it's a lot of work that on the both. It's helpful to have, a GC, I think, and a CFO during the entire IPO process, keeping the trains on the tracks, managing, managing outside counsel is like a whole job on an IPO because there's so many things to do. But yeah, like Julie said, I mean, once you go public, there's so many administrative things you have to, that it's kind of unfeasible to ask the existing C-level team to keep those up. Managing your insider trading plan, for example, right? Like people have to clear trades of the company's stock with somebody who understands whether or not they have MNPI. Like you're probably going to want somebody legal in that role. And the other thing I'll just say briefly is you will sometimes see investors invest in a company and kind of say the CEO is great for now, right? But he's not a public-facing CEO, or she's not a public-facing CEO. And I think it's a reminder to folks who are creating their own companies to make sure you're kind of getting reps, be out there, get used to talking to investors, take as many meetings as possible because you want to instill that confidence. Because it doesn't mean that, when they say public-facing CEO, they don't mean has been a public company CEO before, right? At some point, somebody has to be a first-time public company CEO, otherwise we would run out of them. So you could be a first-time public company CEO, but you need to instill confidence in your investors that you're going to be out there, you're going to be able to sell the company to investors, to the general public, retail investors. And so, yeah, just make sure you kind of get as much practice, selling your company as you can.
Can I just make one comment? Because when we took the company public, I didn't have the benefit of a general counsel. So I was the CFO, general counsel, and chief of all things. So yes, it's a great idea to have one because it's so helpful. But I think one thing other than management that you should think about is that also your board is going to turn over. And it may not have to be on the first day, but I think it's within 3 years that you have to have independent board members. Your finance and audit committee chairperson is probably going to look different. You're going to have you'll have committees. You'll have compensation, governance committees, all these different committees. And many companies, when they go from private to public, right away at the IPO, there's usually about 2 investors, usually early ones, typically come off, and they're replaced with either current investors, or more appropriately, independents, CEOs at other companies that are similar to yours, et cetera, et cetera, et cetera. So I think the big change isn't always the leadership team, but a big piece of the change is going to be the board.
Yeah, definitely.
So I'm told that we need to wrap up, but one final piece of advice for early stage companies that are thinking about eventually going public. Whoever
Well,
wants to
Steve,
start.
I would say what each of you are doing every single day and bringing new technology, whether it's to save lives or to make people's lives better in some way, is incredible. You should be proud of what you're doing every single day, and you should share it with people. You never know who the person you're talking to is not going to be your next best investor or your next best cheerleader, and that's what it's all about, is bridging the exciting things that you do every day with making sure you have the money to further execute it. Somebody told me the other day, no money, no mission. There's actually a book. I didn't know there was a book. I thought it was just a saying, no money, no mission. So please, as you're passionate about what you're doing, make sure you continue to share your story and where you are. Under promise and over deliver. That's my 2 comments for today.
It's hard to follow that. I would just say it's the same. Being a private company, a company with investors that has to tell a story to get more investors, that has to keep current investors happy and continually increase the pool of people who know about the company and who want to support it. That's a perfect description of either a private or a public company. It's the same. There's really no difference. There are different rules of operation, but generally you're doing the same thing. You're doing it with, as you said, they're the owners, the founder is the owner, the investors, the private investors, the owners, but in the head of the executive in the company, it's the same job. It evolves, but it's a little bit like being a parent. Being a parent to a 2-year-old is different from being a parent to a 16-year-old, but it also is kind of the same.
Yeah, I would just say make sure you find, in addition to obviously hiring folks inside the company that are, trusted and good employees, find trusted outside advisors. It doesn't have to be Cooley, but
it can.
But it can be.
should.
But your law firm is going to have done this. You're so many more times than like you as an individual will be able to do it in your lifetime, right? Like Steve has written more S1s than any seasoned CEO has ever done for their multiple public companies, right? Like there are people especially in the Boston area that really specialize in helping startup, early stage, mid stage, late stage companies get access to this capital. It's what we are, it's what gets us up in the morning to make sure that, these great technologies get funded and, just find somebody you like and work with them.
Danielle, before I let you guys go, this has been excellent. Can you guys just touch on launching an IPO in different exchanges, whether it is in London or it's in Boston or it's on NASDAQ, or can you give us any perspective on that?
Well, 99% of biotech IPOs have been on the NASDAQ exchange. There have really been only 1 or 2 on the New York Stock Exchange the last 2 or 3 years.
I think it's moving. I think.
Maybe. Nothing wrong with the New York Stock Exchange. It's just a cultural thing that biotechs tend to go to NASDAQ, and that's if you're in Europe or if you're in London. A lot of London biotechs are looking to go public on NASDAQ. It's just where the money is. It's where the pool
I
of
would
investors
say that's
is.
where the investors are. I think it's the same rules for NASDAQ and New York Stock Exchange. There's nothing materially different between the 2 of them. We did NASDAQ. I don't think it was any other reason, but everybody else does. I think a lot of companies that are sitting in Europe and beyond are going public in the U.S., and I think it's just driven by where the capital markets are.
Yeah, exactly. I think what's going to drive it is where the money is. And
Follow the money.
for the vast majority.
I'll tell you, ringing the bell at NASDAQ is super fun.
Super fun.
Everyone should
Yes,
try to do it
absolutely.
once in their career.
Everyone come to NASDAQ. Come to New York.
It's amazing.
Thank you.
Thanks, guys. This was an awesome panel. Let's give it.
Thanks, Danielle.
Thank you, Danielle.
That was an awesome panel. 6 p.m. You can go get dinner, go get a drink. If you come back here at 6 p.m., we've got Yvonne Chow, the head of economic development in Massachusetts. She's the secretary of economic development, and Scott Kirshner from the Boston Globe. And we're going to be talking about the innovation economy.